Good morning, distinguished colleagues. First of all, I want to thank Patrick for inviting me here, and also to PEMNA sponsors from the European Union and Government of Korea for supporting this important initiative. Today, I would like to talk about the future of finance, how I call this presentation. It's specifically how tokenization and the digital representation of assets on the blockchain is fundamentally transforming both capital markets and payment system across this region and across the world. And in this presentation, we'll explore real examples from Philippines, Hong Kong, Singapore, and other Asia-Pacific countries. These are not theoretical concepts, but they are operating systems with handling hundreds of billions of dollars today and evolving very fast. And my goal is to provide you with a concrete evidence how this transformation and a practical roadmap can help your treasuries to follow. And the Asia-Pacific region is leading in global experimentation in this space, and the decisions we make now will determine whether our economies capture or miss this opportunity. So let us start. First, it's not a little experiment anymore. More than 60 tokenized bonds have been issued just last year by 15 governments in the stablecoin domain, 375 billion of transactions, and the growth, annual growth is double digits. You see 76%. So potentially this can save tens of billions in the infrastructure, enable 24/7 operations, which now are restricted to business days in most of the countries, and also allow fractional ownership, which means reducing the cost and access to financing and fundamentally expanding the market access. So there are two pillars that I want to touch. The first one is how it affects the capital markets, and second, the payment system. So in the capital markets, the most relevant to our experience is the tokenized bonds. And it works only when two systems actually comes together. When both money and bonds are on the same infrastructure, you can achieve atomic settlement. Atomic means almost instant. When settlement purchase happens and the transaction clears, it's almost zero counterparty risk, because you don't keep the resources, either the asset or the financial resources, in the limbo. And this is not possible in the conventional system, where securities settle through multiple systems in the payments and in the custodies and brokers, etc. So the Asia-Pacific region is uniquely positioned because several jurisdictions are already pursuing both tracks simultaneously, like Singapore, Hong Kong, and several other Asian countries that I will mention in this presentation. So why? Let me stop for a while. So in the capital markets, the most relevant for the treasuries will be issuing the digital bonds, which can significantly simplify and improve the access to liquidity that you may need, or placing the excess liquidity. In the payment system, government to payment system, it's a purpose-bound money, and I'll stop briefly on this concept. I actually delivered another full presentation on the budget session, how you can trace the government payments after the funds were actually disbursed. Also, the government-to-government payments, like pilots with central bank digital currencies, multi-CBDC bridges, and for our PFM systems. So what actual benefits do this system deliver? First, the statistics done by the Bank of International Settlements shows that spreads are lower, about 37% on digital bonds versus the conventional bonds. And these are comparison done by the same issuers, same maturity, and same currency. So this deliver a real market improvements and liquidity, especially in the large volume settlements. Second, it's installed settlements. In most bonds on the international market settle within 2 days. On the digital rails, it settles near instantly, basically resolving the contract and eliminating the settlement windows, which keeps the counterparty risk, and it requires us as Treasury management to wait for the cash to arrive. Third one is a fractional ownership on the large issuances. According to BIS, the average size is 185,000 US dollars. On the digital rate, it's way lower, about 110, which provides access to a smaller investors and actually broadens the investors base. It also enables 24/7 trading, so it enhances the market liquidity. So these three benefits, they compound, and lower minimums, continuous trading, and faster settlement together widen the investor base beyond the institutional participants. So for sovereign, it's a deeper and more diverse investor pool, translates in stronger demand, better price discovery, and lower cost to access financing. Let me mention a few specific examples. So Republic of Philippines issued a tokenized treasury bonds as part of their digital transformation strategy, and that wasn't a small pilot, it was a legitimate sovereign bond issuance that met all the regulatory requirements with the innovation being infrastructure layer like blockchain issuance and settlement. The benefits realized were concrete: reduced issuance complexity through automated documentation, faster settlement, from days to hours, and immutable audit trail that simplifies regulatory reporting. The transparency of blockchain also enhanced the investor confidence, and every transaction which was done could be easily verified. And what's particularly noteworthy is the Philippines did it as a developing country, demonstrating that this approach isn't reserved just for the most advanced financial centers. And the technology can leapfrog traditional infrastructure, similar to how a mobile payment system leapfrogged branch banking in many emerging countries. And this has a profound implication for many of countries in the ASEAN. Second example is Hong Kong, which did among the first one, did a multi-currency tokenized bonds, basically expanding the access for investors. And these bonds can be settled in different currencies at the same platform with automatic foreign exchange execution if needed. And this addresses one of the major frictions in cross-border capital markets, which is a currency conversion and settlement coordination. The project Evergreen and their initiative for enhanced collateral mobility is equally important. And today, despite the hundreds of billions which are marketable securities on the global market, just a small one is in the digital rails, and it doesn't allow collateral to settle quickly across the border, which restricts the fungibility of these assets. So the Hong Kong approach demonstrates the sophisticated thinking about financial infrastructure, and they are not just digitizing existing processes, but they are redesigning market architecture to enable a new functionality. The integration with bonds and traditional banking system and emerging blockchain platform positions Hong Kong as a critical bridge between old and new financial system. So let me quickly consolidate what is the capital market story. So first, the smart contracts enable automated settlement when conditions are met and the assets and payments they clear without manual intervention. And this is not just efficiency, it eliminates counterparty risk entirely and delivers the asset versus payment at a protocol level. The collateral management becomes radically more efficient in transitional markets. Moving collateral between accounts and across borders become possible. And accessibility improvements have macroeconomic significance when retail investors can participate in bond markets with low minimums, government gains, funding diversification, when small and medium enterprises can access this financing for their supply chain. And these are not just a marginal improvements, they are structural enhancement to capital allocation. So let me now switch to the payment innovation. And as you can think about this system, like I was talking about the bonds, It's like a good car, let's say Ferrari cars that you have, but you still need a fuel. And for this fuel is a currency or a payment system that you need. So one of the fuel that currently serves this market is a stable coin. It's a very fast evolving market, by now to almost 300 billion market cap. The growth I mentioned is growing 70+%. The billions of transactions are happening, and these are not the typical cryptocurrencies. These are assets that are currencies that is pegged to a real fiat currency. 99% is pegged to the US dollar. So this stable coins domain right now is almost entirely dominated by the coins connected one-to-one to US dollar. What actually is the dynamics of the market, that the transaction count grew even faster, which means that the size of the transaction is going down, and it's becoming a real mean of payment. This is not a crypto speculation, as we may see throughout the 2025, for instance. The crypto markets has declined, but the stable coins payments volume continued climbing. And the infrastructure has matured to the point where it serves genuine commercial needs independent of cryptocurrency speculation. So originally we all thought about its as benefits on the cross-border payments, and indeed it delivers a lot of savings. The current fees, according to the World Bank, on an average $500 transfers is between actually 30+ US dollars. Settlements on wire transfer may take up to 5 days. And obviously it restricts the financial inclusion because of such a high barriers. And all this system of SWIFT, especially between countries, it was designed in '70s, and despite all the improvements, it's still, the way how it can be improved is still limited. While the tokenization input, the settlement or the transfer is directly peer-to-peer, it happens within seconds, and the fees are ways lower. But when we did a deeper analysis, we actually noticed that it's not the intra-region, it's not a cross-border trade, but the adoption is huge on the domestic markets. And this slide actually challenges this prevailing narrative, which assumes that stable coins are primarily for the cross-border payments, like Filipinos sending, or the expats sending money back home, Filipinos working in Dubai sending money to Philippines. The data tells a different story. 84% is actually happening intra-region, with 74% is domestically within single country. So, and the Asia-Pacific region dominates, accounting for 45% of all global payment volume. And it's a bidirectional activity, so it's not just a one-way direction of funds. And the major hubs include Singapore, Hong Kong, Thailand, and increasingly Philippines and Vietnam. So the strategic implication is a larger opportunity. It isn't just replacing the international payment system or like Western Union, or it's becoming really a domestic infrastructure. And stablecoins are competing with the local payment system. We already see this evidence with bank transfers and cash. And this structurally larger addressable market isn't where the growth is accelerating fastest. Policymakers need to think about stablecoins as domestic infrastructure, not just across border payments. So the few examples of other, for instance, China, they piloted and developing central bank digital currency. It's a totally centralized system under full control of the central bank of China. UAE pursued a different route. They basically created a full regulation for different private agents to issue stable coins, and so they provided a fully regulated environment for the private sector to evolve US, for instance, they have not regulated and led the industry to emerge, and just now are coming with the regulation. So there is a major battle happening in the Congress about the regulation of the stable coins these days. So there are different approaches how countries has done it. Actually, I'm running out of time. I will skip the purpose bound of money. So what does it mean for the financial system in the country? It's a three-layer system. The one is central bank reserves, and this is the trust foundation. Second is a commercial bank money, which is a transaction such as tokenized commercial bank deposits or stable coins backed by the by the commercial banks. And the third one is tokenized government bonds, which can serve as a benchmark assets on the market. So what are I outline mostly the benefits of this system. What are the main challenges? And the first one is regulatory fragmentation. European Union moved fast and established the markets in crypto asset regulation called MiCA. US last year introduced the Genius Act. Same happened in Japan and Singapore, but each country is pursuing up till now quite a different approach. And there is a fragmentation, and with different definition and requirements, all these countries has a different networks. So the market agents, they can pursue the easiest path and bypass the regulations on the national markets. So this fragmentation creates possibilities for regulatory arbitrage, and stablecoin issuers can jurisdiction shop. For instance, like the most popular stablecoin USDT, the company Tether, is based in El Salvador, and the stable coins are circulated all around the world. So this international coordination is essential, but very difficult. The IMF is involved. We need the harmonized standards for these reserves assets, for redemption right, anti-money laundering, and compliance. The infrastructure, like I mentioned, this example with a car and a fuel, but also for the car you need a good roads to drive, and this infrastructure should be standardized. This is another the challenge to have the operational resilience, and the concerns are serious. Because there were outages on the market. This is still evolving, and the trust is undermined once people cannot access their money or make the transaction. The smart contracts vulnerabilities create a new risk categories, like bugs in these contracts code have resulted on millions of losses in such protocols. So these contracts, when these contracts govern securities, and this is the ultimate source of truth, this is becoming a serious issue. And for emerging markets and developing economies, this fast evolution of stable coins can actually substitute the local currency, so that can be also a serious issue for the countries. So what are the policy priorities for ministries of finance and for treasuries? Is to robust reserve backing requirements, basically securing that any company which is issuing the stable coins, they maintain the robust reserve and manage hedge any risks, a fixed risk, if they put it in different currencies. There are clear redemption rights, so if the owner wants to redeem, that it can be redeemed at the face value. There is anti-money laundering and compliance framework in place, and consumer protection standards. So what are the roadmap? How do we address it? The first and the immediate actions. For the beginning of the journey, I recommend the 4 actions. First, conduct a readiness assessment. What is your current payment system infrastructure? What is your security settlement infrastructure? And what regulatory frameworks govern digital assets? What skills exist in the financial in the Ministries of Finance and the financial regulators. Second, pilots, and I mentioned a few countries. Some are also considering. I recommend to start through the controlled regulatory sandboxes to have this limited pilots to see how the market reacts and how the adoption happens. Third, pursue regional collaboration. ASEAN is an excellent example, leading ahead many countries, so there is a lot of knowledge sharing that can happen in the platform like this one. And the fourth one is capacity building, training the staff, partnership, including partnership with the World Bank, IMF, other institutions to get the experience from other countries. In the midterm goals is to put a comprehensive regulatory framework in place. This address the different layers. I mentioned the assets, the payment systems, and any service providers that happened. Europe is a good example. The UAE is another one, but also UK financial services are quite advanced in this. We can look and take the examples from this. Second is infrastructure becomes critical. This includes both technology, platforms, digital identity systems, and institutions, regulatory sandboxes, industry working groups, international cooperation arrangements, and this development of infrastructure, it takes years, so better to start early. The third one is a digital identity system integration for financial, so you need a secure privacy preserving identity that works across physical and digital channels, domestic and cross-border, and several jurisdictions are developing the self-governing identity frameworks, so you can examine this too. And the fourth one is engage actively, as I mentioned, with different international bodies, learning from other countries. So I'm convinced that this future is tokenized because it delivers a lot of benefits, faster, cheaper, and more accessible financing. In the payment system, it's instant, it's inclusive, it has features of programmable money, which is not accessible. You have the Asia Pacific is leading the global experimentation, so a lot of opportunities to learn in this region and balance the innovation and risk. So I want to close with clarity about what's at stake. This tokenization of financial infrastructure is not a question of if, it's already happening. We do see it clearly on the private sector markets. The question you face is how quickly you participate and how well you execute. And first movers capture the standard setting influence, infrastructure investments, and talent development advantages. The window for positioning is open now, but it won't remain open indefinitely. Within the next 3 to 5 years, dominant platforms and regulatory framework will be established, and jurisdictions that haven't built capability by then will face the path of dependencies and switching costs, and they will use infrastructure built elsewhere under the rules set also elsewhere. So my recommendation is a decisive action with appropriate risk management, launch pilot, invest in capacity, engage regionally and internationally, balance innovation with financial stability and consumer protection, learn how jurisdiction further along and the Asia-Pacific region can define the future of tokenized finance, but only if it acts, coordination and with urgency. And thank you.